President's traveling in Florida. He's speaking now at a healthcare rally in Florida. We'll see if he addresses this in those comments or if he addresses this to reporters on the way back, and we'll bring you any additional comments the president has here, Kelly.
Eamon, thanks very much. Eamon Javers at the White House.
Well, concern is rising about the economic outlook on both Main Street and Wall Street. Senior economics reporter Steve Leisman is here with more on today's weak economic data and a new CNBC survey showing American economic optimism at a 3-year low. Steve.
Yeah, Melissa, the number of the week was the ISM Services Index, which was weaker than expected, prompting new fears of a broader economic slowdown. Now, both the manufacturing sector and the service sector has surprised to the downside. They've both now been declining since late last year, and both now have hit multi-year lows with no sense of a bottom yet. But hold on, because neither survey yet signals a recession for the broader economy. UBS writing very simply, so the slowdown may be sooner than we forecast. Americans are picking up on this weakness. Attitudes towards the economy took a sharp turn downward in the third quarter CNBC All-America Economic Survey, with 41% now pessimistic about the current state of the economy and about the future. The poll registered the highest level of pessimism since October 2016 and represents a pretty stark change from the heady days just this time last year when the index was hitting new record highs, and I was running out of ways to describe it. The good news, though, attitudes about the current state of the economy this quarter were little changed. It's all about the outlook of the economy. Other key economic indicators in the poll, unfortunately, also down. Just 36% of the public think their wages are going to rise the next year, and that's the lowest since March 2016. 35% say now is a good time to invest in stocks, also the lowest in 3 years. And just 23% are saying the economy will improve in the next year. It's the first time in 11 polls we've now conducted during the Trump presidency that the pessimists outnumber the optimists.
Is that a good sign?
I don't know. I mean, you guys can take all that and put it into your contrarian indicator formulas there. What was interesting was a big decline in optimism among Republicans. And this was taken in the week that all that impeachment stuff came out. The Democrats have not been optimistic under Trump. I think the problem for the president is that the profile of the independent voter looks a lot more like the profile of the Democratic voter than the Republican voter.
In terms of how they feel about the economy.
The economy, a whole bunch of things. And the president's policies did not poll well either on immigration and border security or on relationships with China. But I think that is something that is bothering the public as well.
Steve, appreciate it.
Pleasure.
Mr. Leisman, can the Federal Reserve offset these rising concerns? And what does it all mean for the market? Michael Farr is president and CEO of Farr Miller in Washington and a CNBC contributor. He joins us now along with Bill Stone, who is chief investment officer of Avalon Investment and Advisory, and Margaret Vetrano is portfolio manager of the ClearBridge Large Cap Growth Fund, which is beating the market up 18% this year. So, Margaret, where do you stick your money for the rest of the year then with all this going on?
Look, I think at this point it's really hard to tell whether this is a soft patch or whether this is the beginning of something worse. Clearly, the risks to the market are rising. We have been spending a lot of time thinking about 2015-16 and the mid-cycle slowdown that we saw then. And if you think about what happened then, volatility picked up. There were 2 10% plus drawdowns in the market, but we emerged from that in large part thanks to accommodative policy in the U.S. and China.
I was going to ask, did we emerge from that because of accommodative Fed or because of President Trump's election? Because so much of the data right now, you're exactly right, has taken us all the way back to 2016 pre-election levels.
Hard to say. I mean, you could argue that it was really China that got us going in that direction because oil prices, remember, had been falling in 2015. China launched a very massive stimulus program. And when China starts improving, that means commodities start improving, which means the industrials start improving. And then there's optimism around a new presidency and what Trump may enact. So a lot of similarities between here and there. I think the takeaway is not yet clear whether this is something worse, but the volatility is going to continue.
Bill, where do you stand on what this ISM services number means? I mean, obviously we're not in contraction, but it was worse than expected. It was still a decline. And at this point, you could argue that the Fed would have fewer bullets, if any bullets, to really stave off any sort of recession in the economy.
Yeah, so I think I watch the services as part of, a complement to the ISM manufacturing. I think, so I'm going to take a little step back quickly and say, I think this started off these worries about the market were from the ISM manufacturing falling below 50. We took a look at it all the way back to when ISM started. And it's interesting enough, only 44% of the time does the U.S. economy fall into recession after the ISM manufacturing falls below 50? So it's not the greatest indicator, obviously, of that. And the interesting part is it's actually more dangerous for the ISM manufacturing, more dangerous for your stock portfolio for it to be extremely high. When it actually gets below 50 and we don't go into recession, you're up pretty nicely 86% of the time in the following year. So it's, one of those things where the market's more toppy actually when you get a really high reading on ISM manufacturing. Hopefully, again, you kind of go back to the 90s where we had 5 different times we fell below 50 and you had kind of some of these growth scares. And as long as it's a growth scare as we expect, you should still stay relatively positive on stocks.
For all those instances, Bill, though, do we see that weak manufacturing numbers spill over into the services sector? Because that's really at the heart of the fear right now, that services and, services are a proxy for the consumer effectively. And so the consumer is starting to feel the slowdown in manufacturing that we're seeing in the economy.
I agree. I mean, the hard part is, you're right, and services is a bigger part of the economy. Consumer is a bigger part of the economy now. The problem is we don't have as long of a data set there. But I just say, that is actually what we're focused on. We think the consumer is holding in, even though, yes, things are slowing down. You might say, well, employment, we'll see more tomorrow. But it's not falling off the cliff. And as long as people have jobs and we're seeing wage growth, we think if consumer sticks in there, you can make the argument to me, and I'd probably accept it, that the manufacturing sector of the U.S. is in recession. But what really matters, you're right, is the consumer.
Michael Farr, that tactical positioning has been really important this year. You can be in stocks like Costco and do great, and be in other parts of the market and have done really awfully, especially the more exposed ones to manufacturing and to that side. So tell us where you think investors should stay or start new positions with all of this happening now and as we watch the data.
Kelly, I think that with all of the volatility we've seen, this is kind of the warning sign that perhaps we're entering hurricane season and you ought to hurricane-proof your house. This is we've had enough warnings now that you should be having, I think, some risk out of your portfolio. We have indeed seen a shift over a lot of the year away from the high flyer, more volatile stocks into the more value names, which have underperformed for a long time. Those names that I think Margaret was saying she liked more in the consumer stocks, the consumer durables, those more defensive names. I would also say that you can look at some of the healthcare names, very selectively in tech, and I think at some point you still have to look at the financials, but defense makes sense. You can't look up and be surprised at this added volatility, though I think it's a little early yet to be planning the bull market's funeral.
Margaret, you were saying that we're going back to 2015, 2016, we saw 10% declines. In that sort of environment, does a Disney or a Booking Holdings, do they get dragged down as well? They must, right? Those are the names that you like.
They absolutely get dragged down as well, but I think they may outperform some other areas of the market. I mean, I think tech is going to have more risk than a Booking.com. The interesting thing about Booking is, if you think about it, if consumers don't travel as much, the hotels still need to fill the beds. So they work even closer with the OTAs during that period. They tend to gain share during that period, and the OTAs can cut their marketing costs really easy. So margins went up in the last recession at Booking. I think there's some defensive characteristics in those companies.
Margins, anywhere profit margins can go up in a recession.
Yeah.
Sounds like a pretty good place to be. Thanks, everybody. Appreciate it. Bill, Michael, and Margaret.
Thank
you.
The
bond market now. Rick Santelli tracking the action for us at the CME. Hi, Rick.
Hi, Kelly. So many interesting things that we can learn from today's market. Look at the 10s minus 2s. 14-ish, 15, steepest since early August. We'll call it 2 months. You remember about 5 months ago where the thought was we're at -3, -4, and this means a recession. So now that it's 14, 15, should we all be celebrating? No. It shows us how limited a view some of these historically important barometers are in today's marketplace. Another issue is it also tells us we're beckoning the Fed. Why is 2-year going down faster than 10-year when it's problematic data? Fed, come and help. Now, if you look at 10s minus boons, this is the tightest it's been, the closest to our yields they've been in 20 months, which means it's also affecting the long end as you think it would. And finally, if you look at the S&Ps on top of the difference between 10s and boons, how enlightening that is. You could almost say it's a growth proxy, and our growth is slowing and our yields are getting closer together. Melissa Lee, back to you.
That's a good chart, Rick. Thank you, Rick Santelli. Coming up, the fall season is living up to its name. The Dow is down 3% since the first of the month, and October is only 3 days old. But we've got a guest that says a major rebound is on the way. He will tell us why. Plus, retail stocks falling 3% in the first 3 days of the month on recession fears. A top analyst, though, says there is one name that can weather the storm. Those stories and much more. Stay with us on Power Lunch.
The Bond Report is...
At Argos, save 25% off homewares across thousands of lines. Our autumn-winter home and furniture collection is here. So stylish, you can wear it. With Argos, you're good to go. Offer ends 8th of October. Conditions apply. Subject to availability, selected lines.
Get social with TuneIn. Follow TuneIn on Facebook, Twitter, and Instagram to discover what's happening in the app and around the world. Be the first to know about upcoming games and the hottest new music. Follow @TuneIn and always be in the know.
NFL fans, hear every live game on TuneIn Premium.
Fake to pro size, no, the ham size. He breaks 3 down to the 5.
Yes, call on the 30. Touchdown! 20 to the 15 to the 10. 5, touchdown!
Tonight, hear the home and away call as the Los Angeles Rams visit the Seattle Seahawks at 8:20 p.m. Eastern.
Right up the middle, touchdown.
Trying to dive, touchdown!
At home or on the go, hear the home and away call of every NFL game this season on TuneIn Premium. Upgrade today.
You love TuneIn for live breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
What if you could keep up with cable news even when you're on the go? With TuneIn Premium, you can listen to MSNBC live without any commercial interruptions. All of the news, none of the ads. Listen live on TuneIn Premium today.
Want to know what's happening in right now? The latest headlines are just a tap away with Fox News Talk on TuneIn. When news breaks, get up-to-the-minute coverage on developing stories from around the world. Plus, hear all the Fox shows you watch on your TV. Listen to Fox News Talk around the clock on TuneIn.
These are the top buzzing stories on TuneIn.
Joaquin Phoenix talks about how he and director Todd Phillips developed his laugh for Joker.
He described the laughter as something that's almost painful. It is Joker. It's a part of him that's trying to emerge, right? Because I think we all kind of assume what a Joker laugh is, and it felt like it was a new, fresh way of looking at it.
Oprah Winfrey on what she would have done differently in her life.
I would probably have ended my show and then tried to start a network, because what I did was try to do both at the same time.
Comedian Tiffany Haddish has a special way that she gets rid of fat.
You put Vicks Vapor Rub on your stomach.
Because it helps to eliminate fat cells.
That's not true.
Yes, it does.
That is,
okay, let me tell you something. I've lost 3 inches on my waistline. Don't be hating.
Those are the top stories that are buzzing on TuneIn.
Welcome back to Power Lunch. Retail stocks are soaking in recession fears this week. The retail ETF down 4% so far in October, which is 3 days old. The group is now negative for the year. Here's a look at the biggest losers so far for the month. Kohl's and L Brands down 7%, Macy's down 6%, hit its lowest level in a decade. And names like Gap and Best Buy also under pressure. And Christmas is fast approaching. The National Retail Federation today projecting as much as 4.2% sales growth for the holiday season. But last year, their prediction was well above the actual figure. So can the holiday season help turn the group around? Let's dive deeper into retail with Oliver Chen. He's senior retail analyst and managing director at Cowen and Company. You nervous, Oliver, about what the holidays might bring? Because there's people talking about how many bankruptcies we're going to see coming out of this one.
Yeah, there's a lot of cautious optimism. Another factor is there's 6 fewer days, and November could be tough if it's warmer. So there are fears around the mall and also women's apparel. That being said, there are some great opportunities. I would go for value. I would go for grocery. You think about business models like Costco with an excellent product assortment at great prices. Mm-hmm. We like Walmart and Target as well. And Planet Fitness is a great bargain too. So how do you and what do you own in an environment where the consumer environment's getting tougher?
Yeah, Planet Fitness may be more of a January play, but I'm struck by the absence of department and specialty names on your list. Yeah. Is that because of, it's just not your coverage, or is it because those names are just not going to work, with the exceptions for players like Lulu?
We have so many problems with mall and mall traffic, the less productive mall, and traffic is running -3 to 5. Also, the battle with Amazon is a big factor too. So physical retail is profoundly changing, and companies like Macy's and other department stores really need to close stores and repurpose their stores, and they're competing hard against off-price sector, which is a clearer value. Also,